We are Group 6 and present you our evaluation of KT&G today. The agenda is that we are firstly looking on the industrial and company analysis before we show you our DCF valuation, continuing with the problems and suggestions we have, and then continuing with relative valuation and arriving at a final conclusion.
First, I'm going to start with industry and KT&G briefly. Now, KT&G operates divisions including tobacco, ginseng, real estate, and cosmetics, etc. Since the tobacco business takes about 80% of its total business, we can focus more on the tobacco market. The size of the domestic tobacco market has been increasingly shrinking since 2002. However, their global market sales increased a lot, and now overseas sales exceeded the domestic sales. In 2015, KT&G exported 39 billion sticks, and an increase of 10% over the previous year. Sales also grew 28%. Not only the strongest points of KT&G, we made some intriguing points of KT&G. First thing is its great market share in Korea. Wholesome domestic market share of KT&G is expected to maintain based on the launch of new quality products. Second is ruthless expansion of its business lines. As the several departments do not seem to cause competitive advantage, its expansion could be seen as unless things. Third, the governance problem. There is no national authorities that monitoring the management and supervision of the company. Fourth, reducing smoking population. The increase in tax increases and smoke-free regulations, smoking population trend has continued reducing. Fifth, large portion of account receivable. The ratio of the total sales to accounts receivable one is up to 74%, compared to the industry average of 1%.
Now I will explain DCF valuation. We used RF as 10-year Korea Treasury bond and considering default spread for Korea. We used implied ERP instead of historic ERP. We used Hamada equation to find out fundamental beta of KT&G, and we got levered beta as 0.7. Cost of debt, cost of equity, and weighted average cost of them is 5.79%. We assume the tobacco companies to have 5 years of R&D life and reflected it in financial statement. As you can see, we got FCFF, ROC, reinvestment rate, and growth rate like this. To get terminal value, we put 1% of growth rate and 1 of beta and 0 of excess return. It gives WACC of 7.74% and RC is same as WACC. Compared to 128,001, which one is current price on June 7, value per share is 9.62% downside. We also conducted sensitivity analysis for DCF valuation. We adjust WACC and growth rate, which are key inputs. Range between plus minus 0.25% is realistic options. So we came approximately 108,000 to 124,000.
Okay, now we are coming to the problems and suggestions about KT&G. First, we have 2 problems which we found are worth considering them. The first one is the diversification on the sea level, and the second one is the focus on the Korean market. As we have found out, the diversification of KT&G is too high. Compared to the competitors, some of the companies have a dominant business like Imperial Tobacco and British American Tobacco. Philip Morris is close to being at the ideal point of a related constraint level of diversification, while JTI and KT&G need to reduce their business diversification. And that's why we suggest KT&G should only focus on tobacco and ginseng to downscope. How can we do this? First idea is we want to go international, and instead of diversifying, and this comes from the point that new brands for refugees in Europe should be accomplished. Out of 3 million refugees, we have about 2 million smokers, and of those, about 10% don't have their favorite brand inside Europe. That's why we want to focus on half of the group, or set this as a target group. And out of this target group, out of this 100,000 smokers, you will generate about 36.5 million packages of cigarettes per year. The package price is about €5.14, meaning that 55 cents will probably stay inside the margin, creating an additional profit of €20.7 million per year.
Besides the effect of suggestion we mentioned earlier, we also did a DCF evaluation based on the suggestion. We mainly focused on adjusting variables for terminal values. We increased growth rate to 1.15%, but it is still lower than risk-free rate. And we also gave beta of 0.8 because we assume KT&G will focus on tobacco and ginseng only. It gives us a WACC of 6.44%. And we assume KT&G will keep the excess return, which is ROC of 10%, because they can keep their sustainable competitive advantage by downscoping the business. In conclusion, the value per share is 148,687 won and is 60.16% upside the current price.
Next, I will show relative valuation. First, we chose comparable companies using criteria like growth and cash flow and risk. KT&G is the company with low growth and has non-cyclonic cash flow and has risk related to regulation and health issue. So we choose 30 comparable companies in this section. Next, our team chose price-earning ratio to evaluate KT&G against the firms in peer group. P ratio is the ratio of market price per share to the earning per share. We define price using price on the June 7th and measure EPS as trailing 12 months and apply the same ratio to all the comparable companies to keep the uniformity. Then we pursue consistency. Both the value and the standardizing variable should be to the same holders in the firm. As you can see, this is per PR of comparable companies. Finally, we tried regression approach to obtain fair value. As a result, regression of P ratio and P ratio on expected growth rate of net income has shown a significant result with KT&G being slightly below the trend line, but still within one standard error. Therefore, based on the relative valuation, advice for KT&G is hold recommendation.
As a conclusion, our team came up with both DCF valuation and relative valuation. Our DCF valuation shows that KT&G is slightly overvalued by 9.62%, so its fair value should be 115,682 won. For the relative valuation, we did a regression analysis with P ratios to the expected growth rates. And KT&G was placed within the range of plus minus one standard error, which means that the price of KT&G is neither overvalued nor undervalued. However, our team decided to use DCF valuation rather than relative valuation in concluding our recommendations on KT&G stock. This is because our strategy was long-term value investment. So we thought that the DCF valuation fits more to our objective. And although the DCF valuation shows that KT&G has a downside potential of about 10%, our strategy was to screen the stocks that are under or overvalued more than 15%. Therefore, based on the DCF valuation, our recommendation on KT&G is to hold the stock. Nevertheless, we should keep an eye on KT&G since the company has a potential to enhance its value if well managed. Thank you.